Hey everybody, what's up? This is Mike Mai. You're tuning into the first episode of Real Estate with Mike Mai, and today I have Mr. Jeffrey Vilks.
I'm here, guys.
And yeah, so a little bit about me. My name is Mike Mai. I'm licensed in the state of Pennsylvania, born and raised in Philadelphia. I do most of my work out here in Philadelphia. Hang my license with Prosperity Real Estate and Investments. And Jeffrey, tell me a little bit about yourself.
So I work with Movement Mortgage. We're a direct lender. We offer a wide range of products. I personally specialize in first-time home buyers. That's what I've been focused on for close to a decade now. It's a difficult subset for mortgages. A lot of loan officers have difficulty working with first-time home buyers because you're dealing with grants and niche products and income restrictions, etc. That's hopefully why I'm here, to give you guys some more information on that.
Yeah. Okay, let's get straight to the questions. All right, question number one. Do I need great credit to get a mortgage?
So you do not need great credit. One of the things I will say, because credit scores are available on so many apps now, it is important to monitor your credit. It's important to know what your credit is. I would stay away from Credit Karma, but you do not need great credit. FHA, technically speaking, could go down to 580. Conventional loans start at 620. So you don't need an 800 or absolutely perfect credit. You could actually have no credit and still qualify by using trade lines. So you absolutely do not need great credit. Although it's easier to obtain a mortgage and get better mortgage products, the higher your score is. So you definitely want to put your best foot forward when applying for a mortgage.
Okay. All right, question number two. What are closing costs and how much should I expect them to be?
So when you're purchasing a home, closing costs can consist of your down payment, which is whatever mortgage product you choose. They're going to require you to put a certain amount of money down. That's your down payment. The closing costs also will consist of money you're going to put into escrow, which is you're going to pay in advance for taxes, property taxes, homeowners insurance. You're going to have to pay title insurance. You're going to have to pay transfer tax if you're purchasing a home. So all of that gets included. The way I like to explain it is it's a bucket of money that you need to bring to the closing. Don't focus on just down payment and closing costs. Just think about I need a bucket of money to go to closing. How much does that amount need to be? And that's when you start paying attention to which mortgage product you're going to select, hopefully to minimize how much down payment and how much in closing costs you're going to actually pay.
Alrighty. All right. Question number three. How much of a down payment do I need?
That's the best question in mortgage. How much of a down payment do I need? So if you're taking a conventional loan, you could do as little as 3% down. If you're doing an FHA loan, you need as little as 3.5% down. If you do a USDA loan, you can do as little as 0% down. And if you do a VA loan, so if you're a veteran or related to a veteran or married to a veteran or vice versa, you could do 0% down as well.
Mm-hmm. Alrighty. Now question number four. What type of mortgage is best for me?
So that's a very difficult question to answer. What kind of mortgage is best for you? Each program, conventional, FHA, USDA, VA, all the different products have different benefits. So every person's unique. Some people might need the benefit of, if they have a lower credit score, FHA might be a better option. It's easier to qualify and it gives you a better interest rate than going conventional with a lower credit score. If you do have a better down payment, if you do have a better credit score, conventional might be the better way to go as well. One of the other comparisons, which we'll cover later, is because there's going to be mortgage insurance involved. So if you're doing a minimum down payment, you need to pay attention to which product will give you a better overall monthly payment. That's a lot.
Yes, it is. Question number five. What documentation do I need to get pre-approved?
All right, so to get pre-approved, you definitely want to be able to document the last 2 years of your employment history. Mm-hmm. You want to have your W-2s readily available, preferably have it in PDF format on your phone or on a computer. You want to have the most recent 2 pay stubs. It might get more complicated if you're an hourly employee, if your hours have changed, if you've changed positions in the last 2 years, because what you're really trying to show is a demonstration of what you've been able to earn. So if you started a new job and that new job is paying you more now than before, they might not give you full credit. They're going to average your income from before and now. Mm-hmm. Because again, if you're hourly and you're not guaranteed to be working 40 hours every single week, the bank is going to be conservative in the calculating your income. If you're self-employed, if you started doing Uber, Lyft, all these other jobs, Be prepared to provide your tax returns and your 1099s. If you're applying for any grant programs, they're going to look at everything. So child support, if you're paying it or receiving it. Again, if you see deposits coming in from Uber, Lyft, DoorDash, etc. So you want to pay attention to, and you want to also give your loan officer all of this information. Don't let them hunt for it. So if they ask you, what do you make, where do you work, don't just tell them your employer, tell them any job that you're currently working or worked recently.
And also one more thing, like to make his life easier, don't take a photo of your W-2s. If you can, scan it and then send it to him, because it makes his life a lot easier.
Yes, it does.
Alrighty, question number 6. It says, what does my mortgage payment consist of?
So when you're making your monthly mortgage payment, it'll consist of principal and interest. So however much you borrow, it's going to be your principal and interest. Depending on if you're putting down less than 20%, you will always be required to pay with your mortgage your property taxes on a monthly basis, your homeowner's insurance on a monthly basis, mortgage insurance if you have less than 20% down and the program requires it. Mortgage insurance will also be part of your monthly payment. The only thing that you might have a monthly payment on that's not going to be included in your mortgage is if you buy in a development where there's a homeowners association or a condo fee. That's paid monthly, so we don't collect it. So that you're going to have to pay on your own.
All right, question number 7. Why does it take so long to close a mortgage?
So one thing I will start with is if I do your loan now that I'm at Movement Mortgage, it doesn't take long to close a loan. We underwrite in the first 6 hours initially. We try to clear to close the borrower in 7 days, and all we're waiting for after that is title and appraisal. Most lenders, that's one of the things you want to pay attention to when you're comparing a lender. What's their capacity and what's their process, because they might take 30 to 45 days because of how much staff they have and what their overall process is. They might not even look at your loan for 3 weeks. So that's also one thing you definitely want to pay attention to. It doesn't have to take long, but if you go to certain places like credit unions or big banks, they usually take longer.
7 days, guys. This is why I work with them. 7 days.
7 days.
Okay, alrighty. Question number 8. How is my mortgage payment determined?
So depending on how much money you borrow, so when you're getting pre-approved, if you borrow, and I'm just going to use an even number, $100,000, that payment's going to change from house to house. Because what we're going to be looking at is not just how much you're borrowing, but what's the property tax on that specific house, how much is the insurance going to be on that specific house, because that's going to change your monthly payment. So if you're looking at, A block, and A block has taxes of $1,000 a year, and then you look at another house that still costs $100,000, but their taxes are $2,000 a year, that's going to change your monthly payment. So you want to pay attention to how much the taxes are and where you're looking. One of the biggest things that lenders have difficulty with is you tell me you're looking in Philadelphia, and I give you a pre-approval, and then next thing you know is, oh, we're going to go see this house that's in Bucks County. I mean, it's a complete game changer of how you qualify. The closing costs are completely different, and the monthly payment's going to be completely different.
Question 9. What should I do during the contract process? Is it okay for me to buy a car while I am under contract?
You should absolutely do nothing while you're under contract. You should freeze everything.
Freeze everything.
You never want to get out of the norm. You don't want to start overutilizing your credit cards. You don't want to open any new accounts, because keep in mind what an underwriter is doing. The person that's actually going to approve your loan, they're looking at you at a moment in time. During the process, the banks will be monitoring your credit, and right before closing, they're going to re-pull the credit. So if your debt's skyrocketed up, if a new account hits your credit, they go back to underwriting, and then you got to hope that you still qualify. There have been times where it might have affected your score, it might have affected your debt-to-income ratio because a new account popped up. So you got to imagine, like, if you got pre-approved and you said, what's my max approval, and you actually bought a house at your max approval, and then all of a sudden a $300 car payment comes in, well, now the underwriter's got to look at it and say, okay, well, you were max approved already. Now there's a $300 payment. You're either going to have to find a way to pay off the car, put in somebody else's name, or you might be denied. Because they're going to say, now you can't afford it. So you want to definitely freeze and don't do anything.
So no big cars, no huge deposits, no huge withdrawals, don't move money around. That's that. Okay.
Yep.
All right, question number 10. What are the advantages and disadvantages of FHA and conventional mortgages?
So each one of them have, again, like the benefits. Let's cover the benefits first. FHA, like I said, if you have lower credit scores, FHA is usually a better option to go. It's we'll call it cheaper. The interest rates are better, and the mortgage insurance is usually better on an FHA if you have lower credit scores. If you have a high credit score and you still want to do a minimum down payment, conventional can go as little as 3% down. There's options to have no mortgage insurance. There's options to have reduced mortgage insurance. Conventional does give you more options, and then eventually on a conventional loan, the mortgage insurance will fall off, where FHA, it'll be on there for life. You'll have to refinance out of it. So that's one thing you want to pay attention to. If you're buying a multi-unit property, FHA's, again, probably a better way to go because they still only require 3.5% down. Conventional could be as high as 15% down requirement.
Okay.
At the moment, guidelines change regularly. At the moment, 15% down if you go conventional. So down payment is better FHA than conventional at that point. If you're doing a 2-unit, 3-unit, or 4-unit property.
Alrighty. And last question: can you tell me a popular grant option for me?
So right now, the popular grant that's I think took off like a rocket is the PHFA K-Fit grant. It's 5% of the sales price. One of the things you need to have is you have to have at least a minimum 660 credit score. And then say, for example, you're buying a $100,000 house, they'll give you $5,000. You're buying a $200,000 house, they're going to give you $10,000, and up and up. So it's a phenomenal product. It's forgiven after 10 years. There's no monthly payment on it. It has to be your primary residence. In Philadelphia, you do not have to be a first-time home buyer to get it. So as long as your income qualifies and your credit qualifies, you could have owned a home. You could be selling your home, buying a new home. You could still be eligible, which is what makes it so popular.
Alrighty, and that's that. So you want to give like the audience an outro, like how could they contact you? Like, because I'm gonna post up your social media, like you personally.
So if anybody's interested in getting pre-approved, we make it very easy. I have a mobile app that you can download that also has a ton of resources on there that explains a lot of the content we just covered. You can shoot me a phone call, text message, email. Mike Meyer will be posting it with the video below. So take a look.
Or I have like a link somewhere around here. But yeah, most
Just
likely,
pop it up.
yeah, or like in the description below. But yeah, thank you so much, Mr. Jeffrey Vilks, for your time. And like I said, this is the best of the best in the field. Like I've worked with him for so long, and actually in the beginning of my real estate career, and this guy has yet to like let me down on anything at all. But yeah, thank you so much, man. I really appreciate your time.
Pleasure.
I really do. All right, guys, thank you so much for tuning in. Like, subscribe, and comment.